With the COVID situation at hand, we are all short in cash. Neither is our economy booming. Let's take this time to evaluate our wealth and strategies for our next step towards success. One often thinks twice about finances, where they can get the most shot long term. What will give them the greatest return with the least amount of risk? How much risk would they have to take? How hard do they have to fight for that? And what would be the best benefit for them? Hey go-getters, welcome back to The Early Investors, another profitable episode where you can learn how to become financially free. In today's videos, we will be showing you Millionaire Investment Strategy 2021 for beginners. Want to become the next Warren Buffett? Stay with me to find out all the tips and tricks to save your hard-earned simoleons. Before we jump into the video, make sure to subscribe to our channel for more business-related content. We've narrowed down some steps that you can follow. Step 1. Get started investing as early as possible. One of the easiest ways to see solid returns on your cash is saving while you're young. That's due to compound interest, which ensures that your investment returns continue to gain their own return. Compound interest causes the balance of your account to snowball over time. In practice, how that works: let's assume you spend $200 for 10 years every month and receive an average annual return of 6%. You will have $33,000 at the end of the 10-year cycle. On that number, $24,200 is what you've contributed, those 200 monthly donations, and you've received $9,100 on your investment. Of course, there will be ups and downs in the stock market, but investing young implies you have centuries to ride them out and decades to build your cash. Even if you need to start tiny, start now. Step 2. Decide how much to invest. Depending on your investment target and when you need to achieve it, how much can you spend? Retirement is one common investment target. Your first savings milestone is easy if you have a retirement account at work, such as a 401k, and it provides matching dollars. Contribute at least enough to that account to earn the full match. This is free money, and you don't want it to be lost. You want to plan to save a total of 10% to 15% of your retirement income per year as a general rule of thumb. Your employer match counts against that target. Now, that may seem unrealistic, but over time, you will work your way up to it. Consider the time span and the amount you need for other investment purposes. Then work backward to split that amount down into monthly or weekly investments. Step 3. Open an investment account. You should save for retirement in an individual retirement account like a conventional or Roth IRA if you don't have a 401k. You probably want to avoid savings accounts intended to be used for retirement and thus have limits on when and how you will take your money back out. And select a taxable investment account if you're investing for another reason. At any time, you can withdraw money from a taxable brokerage account. A common misconception is to open an investment account or get started investing. It would help if you had a lot of money. That's not true. Many online bankers that provide investment accounts for both IRAs and standard brokerage need no minimum investment to open an account. For relatively small amounts, there are plenty of investments available. Step 4. Understand your investment options. If you invest in a conventional or Roth IRA or a regular investment account with a 401k or similar employer-sponsored retirement plan, you choose what to invest in. Understanding each instrument and how much risk it carries is crucial. For those just starting out, the most common investments include: first investment is stocks. A stock is a single company share of ownership. Often, securities are classified as equities. Depending on the business, stocks are bought for a share price varying from single digits to a few $1,000s. Second is investment in bonds. In essence, a bond is a loan to a corporation or government agency that promises to repay you in a certain number of years. In the meantime, there is an interest for you. In general, bonds are less risky than stocks because you know exactly when you're going to be paid back and how much you're going to receive. Yet, bonds receive lower long-term returns. So only a small portion of the long-term investment portfolio can be made up of them. Third is investment in mutual funds. A combination of shares packaged together is a mutual fund. Mutual funds allow investors to bypass collecting individual stocks and bonds and buy a diverse collection in one transaction instead. They are usually less volatile than individual stocks because of the inherent diversification of mutual funds. A professional manages some mutual funds, but index funds, a category of a mutual fund, follow a particular stock market index's performance, such as the S&P 500. Index funds can pay lower fees than managed efficient mutual funds through the elimination of skilled management. Many 401ks offer a curated range of mutual or index funds with no minimum contribution, although such funds may require a minimum of $1,000 or more outside of such plans. And at last, it is investment in exchange-traded funds. An ETF keeps multiple individual investments bundled together, much like a mutual fund. The distinction is that the ETFs trade like a stock during the day and are bought for a share price. The share price of an ETF is always lower than the minimum investment requirement of a mutual fund, making it a good choice for new or small investors. Step 5. Pick an investment strategy. Your plan for investing depends on your saving goals, how much money you need to achieve them, and your time horizon. Almost all of your money will be in stocks if your investment target is more than 20 years away, like retirement. But it can be difficult and time-consuming to select particular stocks, so for most individuals, the easiest way to invest in stocks is through the low-cost stock mutual funds, index funds, or ETFs. The risk associated with stocks means you are best off keeping the money safe in an online bank, cash management account, or low-risk investment fund, whether you're investing for a short-term target and need the money within 5 years. Step 6. Take calculated risks. When the odds are in their favor, millionaires take chances. A major part of being able to take chances can put at risk the wealth available. To a millionaire, an investment loss of $20,000 or $30,000 gone wrong won't bring them to the poorhouse. Consider what these losses would do to a paycheck-to-paycheck living household, and you can quickly see why millionaires can afford to take calculated risks like this. Millionaires don't restrict just stocks and bonds to their portfolios. To start a company or invest in private equity transactions that require large initial investments, many use money. Step 7, and the last step, is to buy appreciating assets. In reality, most millionaire funds and investments are pretty dull and look nothing like the stereotypical millionaires seen in ads for glossy travel magazines. They own relatively simple cars, sedans and pickup trucks, mostly domestic brands, and live in reasonably priced houses. They also save 20% or more of their income into retirement funds, in addition to investing a large part of their income in tax-deferred saving instruments such as 401ks and IRAs. Millionaires recognize that cars tend to lose about 10% per year of their value, while stocks tend to gain about 10% per year. While houses are often presented as valuable assets, they don't appreciate everything that much. The last century's housing price statistics have been analyzed by Nobel Prize-winning economist Robert Shiller, who has found that real estate has risen in value by an average of 1% above inflation each year. And in all, the premiums, taxes, and maintenance costs, and it turns out to be a pretty bad investment to buy a large house to live in. That doesn't mean that a bad investment is always in real estate. By purchasing real estate and renting it out to generate revenue, several millionaires have been minted. And with that, we've reached the end of today's video. I hope you enjoyed it and found it useful. Feel free to ask us doubts, if you have any, in the comments section. If you found this session informative enough, make sure to smash that like button. Also, subscribe to our channel and ring the notifications bell so you don't miss out on our latest videos. Thanks for watching, I'll see you in the next video.